Good morning, everybody. Welcome to the Reserve Bank and our December monetary policy statement. The Reserve Bank this morning is leaving the official cash rate unchanged at 3%. We also are saying that interest rates are now projected to increase to a more limited extent over the next 2 years than we had projected back in September. The pace of economic growth in the New Zealand economy appears to have moderated. Corporate investment intentions are now below average. The household spending remains weak, with household credit still flat. Housing market activity is slowing further, and indeed house prices may still decrease a little further in the near term. This continued household and business caution means that the low interest rates that we have are having a little less stimulatory effect than they might have had at these levels in the past. But on the positive side, activity in our trading partners continues to expand. Growth in the Asia-Pacific region remains strong, and actually growth in the United States and Britain has turned out a little stronger than we expected as well. Export commodity prices for New Zealand, already very high, continue to increase. And of course this is encouraging for us, though we can see downside risks to global growth and export prices in the future. The repairs to earthquake damage in Canterbury are now expected to add more to GDP growth over the period. We calculate that the earthquake has likely caused damage of around $5 billion to residential property, commercial property and infrastructure. Our near-term outlook for GDP growth has softened, but in the medium term, higher export volumes and the earthquake repairs are expected to push our GDP track higher above that projected back in the September monetary policy statement. As growth recovers, spare capacity will gradually be used up in the New Zealand economy, and this will inevitably cause underlying inflation pressures to pick up. In the near term, the increase in GST is now going to cause headline CPI inflation to spike temporarily, although we note that so far we see relatively little evidence of this affecting price and wage setting behaviours. While interest rates are likely to increase modestly over the next 2 years, for now we judge it as prudent to keep the official cash rate low and keep it until recovery looks more robust and underlying inflation pressures become more obvious. The New Zealand dollar has increased significantly since the September monetary policy statement. Sustained strength in the currency is inhibiting rebalancing of economic activity in New Zealand towards the traded sectors. Finally, we observe that accelerated elimination of New Zealand's fiscal deficit could help improve national savings, and that in turn would likely reduce pressure on interest rates and on the New Zealand dollar and decrease New Zealand's dependence on foreign borrowing. Thank you very much, ladies and gentlemen. That's the end of the formal part. We're happy to answer questions. To assist, I have Dr. John McDermott, Head of Economics, and Dean Ford, Head of Forecasting. Thank you.
Just on that last point, Dr. Bollard, are you effectively offering the government a deal here, lower interest rates and maybe a lower dollar in exchange for tougher budgets and a faster return to surplus?
Well, where fiscal policy goes does impact monetary policy. We're saying that's certainly true at the present time. We're not offering deals in that sense, but we do think it's important to be aware of the interrelationship of fiscal policy on national savings, on exchange rates and on the interest rate.
Dr. Bollard, how concerned are you about what seems to be a growing drought in the Upper North Island?
We're monitoring soil moisture conditions quite carefully. We observe that it's been pretty dry in Northland and parts of Waikato and parts of South Canterbury. And that does look dry for this time of year. We'll keep monitoring those. We see that as a downside risk on production, but too early yet to see it having a real impact through on our forecasts. We do observe that New Zealand agriculture now looks a little bit more sensitive to soil moisture than it used to in the past, and that's why we keep hearing words like dryness and drought rather more frequently than we used to in the past as well.
Is that perhaps a reflection of greater intensity, more dairying? Is that?
Yes, it is.
The forward track for current account deficits looking a little more favourable than it was. Is this the rebalancing that is sort of the word of the year, or is it just the fact that we're going to be growing a bit more slowly over the next few years?
Well, we think it's partial rebalancing of a desirable sort. We also note, of course, that you can still see the effects of the bank tax payments in there, and in addition, we're anticipating in the quarter just finished that you'll see the impact of reinsurance flows for the Canterbury earthquake coming in. It's conceivable we could even have a positive current account balance number for the third quarter, but that would be a temporary phenomenon. When we look out further, we see an improved track compared to September, but still one where there's a growth in the deficit.
There's been some pickup in the most recent business sentiment surveys, but you seem to be discounting them a bit in these forecasts. Why?
Well, we have seen some pickup, or most recently in the National Bank Business Opinion Survey. There's been some mixed evidence beyond that. However, some of the data that's come out, and you've seen it over the last few days for the third quarter, has persistently looked soft, reflecting continued caution. We monitor bank credit quite closely, and we just see that still remaining flat, but with an expectation that it picks up to help fund investment next year. So we do see a pickup in the business sector, but it's gradual.
So just generally, how would you see the economy? It would seem that it's in a fairly stagnant state at the moment.
Well, not exactly. We'd say domestically it looks very cautious and quite flat, but we are getting these extremely strong export commodity prices, and that of course is helping the New Zealand economy considerably. It's the main engine of growth at the moment. You're seeing farmers banking a lot of those returns as they seek to reduce debt on their balance sheets. We would expect next year that you'd see more evidence of that around high street spending.
Dr. Bollard, do you think the earlier couple of moves up in interest rates were a misstep? That you regret those now?
No, not to date. I mean, we'll keep watching how the economy progresses, but assuming that we're on track on our forecast that we've got now, no, we think that was still the appropriate thing to do. That's not to say that the economy hasn't surprised us in the softness of its short-term recovery.
Dr. Bollard, on the issue of the government's deficit, is there a risk that they take your advice and start cutting their stimulatory measures too much and actually make things worse, not better?
Well, I mean, the government's got to work out its own fiscal policy, obviously, and take into account the balance of instruments and the balance of stimulus that comes out of that. I think what we're partly talking about isn't major in stimulus terms or stimulus withdrawal terms. It's more a question of moving the mix of tools towards towards less pressure from government spending, being able to help our tradable sector in its recovery. So it's really a mix and the balance. If we apply monetary policy, it impacts right across the economy. We see a situation where accelerated fiscal reduction could help national savings, and in doing that assist the exchange rate from being too strong and thereby help the traded sector.
Are you prepared to identify an area where they could cut back or improve the deficit? Any particular area of spending that worries you?
No, that's not our business. We do monetary policy. We're interested in the overall balance of fiscal policy and monetary policy, but that's entirely up to the government how they do that.
Dr. Bollard, you say you're expecting a slight further fall in house prices. To what extent, and is that being driven by the even a slight increase in floating rates earlier this year?
We're expecting house prices to fall over the next couple of quarters, but in total about another 1% or so. So that follows a period where we've seen house prices drift off about 3%, so it's a fall in aggregate of about 4% over a 2-year horizon. Again, it's more caution from the household sector, some lessons learned out of the global financial crisis that you can't completely leverage up all the time. And yes, interest rates just nudged up slightly. At least official rates, mortgage rates have sort of shifted, so some floating rates went up, some fixed rates went down. I think that's a pretty small part on the house prices at this point.
You wouldn't draw a direct link between that rise in the floating rate earlier in the year and what's happened with house prices and house activity in recent times?
We're putting it more down to a behavioural response from the household sector, and certainly the fact that they've been told that interest rates went up slightly was possibly the straw that broke the camel's back, but there are other factors involved in that.
Dr. Bollard, could you talk a bit more about how you're seeing deleveraging changing the way the economy is working, and how much research or knowledge you have about how long it might last and what impact it might have?
Yes, well, we're seeing businesses looking to reduce debt, and we think generally doing that. We're seeing farmers looking to reduce debt, and in the case of some of the dairy farming sector, they of course did take on a lot more debt over the last few years, and one can clearly understand why they would want to reduce that now. We're seeing householders also looking to reduce debt. They're broadly doing it in a passive way by paying back the same amount on mortgages and reducing principal there. We can understand why in the medium term householders would want to do that. It's a question about over what timing it should happen. We're seeing a lot of caution in all those sectors. With businesses, we think that'll pick up next year. Business balance sheets look to be in pretty good shape to us. Household balance sheets, we can understand why restructuring or deleveraging might happen, but of course it's hard to actually delever while your house value is coming down as well. So it's more attempts to do that. It's certainly reductions in total debt in the household sector like that. How long will that continue? We don't know. We've been a bit surprised by just how cautious that sector has been. We are doing quite a bit of internal thinking around this, but we haven't actually been in a situation quite like this before, so it's not something that you can simply model. There could be a temporary behavioural change. There could be an attempt to reduce debt down to levels that are in people's minds and then get back to more old normal behaviours, or there could be a new normal consisting of an ongoing reduction in debt, and we'll be observing that. We have the advantage of being able to do that at this time by keeping rates where they are. We feel reasonably comfortable about that. If we get evidence of people starting to recover and starting to borrow again, we've got plenty of room, we think, around monetary policy to adjust to meet that.
Dr. Bollard, you seem reasonably relaxed about the inflation outlook at the moment. Are there pockets of concern, local government rates, electricity charges still going up? Any concerns?
Well, I mean, there are quite a number of administrative price increases currently underway, as you're aware. factors. GST, of course, is an emissions trading scheme. We're still seeing the impacts of tobacco increases, excise tax increases, and some other things. But the general picture we've seen through the GST introduction was of very high degree of caution by retailers, sometimes but not always passing on a GST increase, very rare evidence of passing on more than a GST increase. That cautious behaviour means it's much easier for us to run monetary policy through this aimed at the medium term. We'll keep observing that, but at the moment, relaxed, well, no, we're a central bank, we don't get relaxed about inflation, but we're observing behaviour that's pretty much in line with expectations and leaves us reasonably comfortable about our focus.
Do you have any worries about petrol prices, which are on the way up again?
Well, of course, the strong New Zealand dollar has had at least the beneficial effect of reducing inflationary impact of those. So at the minute, no, we're not seeing major pressure to pump from that.
Just on petrol prices, I mean, close to $2, do you expect that to also dampen economic growth, reduce spending in other areas?
Not particularly.
How concerned are you about Standard & Poor's warning about a possible downgrade, given that your own forecasts suggest a current account deficit increasing over the next few years?
Well, we have to admit to have been slightly surprised by Standard & Poor's coming out with the announcement a couple of weeks ago on negative outlook for the sovereign. We suspect that's probably more likely a realignment of their expectations around the Irish crisis and sovereigns generally. I'd say that partly because many of the things they mentioned have actually improved in New Zealand over the last year. But that shouldn't take focus away from the fact that there is real market attention on sovereigns, and one can't take anything for granted in this quite volatile capital market period. So we have to take that seriously. It seems to me a good reason why we should be focusing wherever possible on rebalancing, continuing. As you say, the current account balance improves, but then it deteriorates again on our forecast.
How much do you think the New Zealand dollar could be lower, or interest rates could be lower, if the government was able to reduce its structural deficit?
Yeah, I have to decline to answer that question, principally because we can't. We don't know exactly. There isn't a mechanistic relationship between the two, as you're obviously aware. There's a whole bunch of other factors that could come into play. We think it's one of the reasons, though, why one might expect to see a lower impact on interest rates and exchange rates. Even from hindsight, you would never actually be able to reach a number on that. Ladies and gentlemen, any other questions? Bernard?
Just one more. Are you happy with the way that the credit system is working to get credit out there? Are the banks playing fair? Are they holding things up, or is it purely a demand issue?
Very happy. Ladies and gentlemen, thank you very much. It's been the end of a confusing and sometimes difficult year for us all. Thanks for your attendance and all the work you've done interpreting what we've been doing. I hope you all have a good Christmas. May your assets and liabilities remain in balance. Thank you.